Hey,
Guys.
what's up, everyone? It's Dave and Adam here with the Real Estate Dads. We hope you're doing well. We've got a special guest with us today to talk about the lending world, Daniel Gatt, Finance of America. Is that your kid back there, buddy?
That's my daughter, 18 months old. She wants to be part of your video.
Again, Daniel Gatt with Finance of America. We've got him here to answer some of our questions. A lot of things have changed since we've been dealing with COVID-19, the virus. The real estate market has certainly changed the way we do business, and we wanted to bring Daniel in to discuss how the finance world has changed. Daniel, thanks for joining us.
Thank you for having me.
I guess first and foremost, everyone asks about rates, whether we're in this type of situation or not. So why don't we start there? What have you seen changed over the last few weeks since we've had these stay-at-home orders and dealing with all of this?
Yeah, so it's a very interesting question because the rate market has not followed any of its normal path. So normally you can look at, for the last 20 years, you can look at the 10-year treasury yield and easily say that mortgage rates are going to be somewhere between 1% and 2% above whatever the 10-year treasury yield is. I can show graphs, not on this video, but there are graphs that illustrate that it's always been that way for 20-something years. And in the last 4 weeks, there's been no correlation between the two whatsoever. So we are definitely, just as the world is with health, the mortgage world is in uncharted territories where there's no way of predicting what's happening. But what I'm seeing right now is I believe banks are having liquidity issues as far as what they sell on the back end, and their lines of credit. And because of that, what I'm finding is that rates on mortgages that are up to $510,400, which is the conforming limit nationwide, they're remaining fairly low, like in the low threes for 30-year fixed. But when you go above that amount and you get into what's called the high balance conforming loans, which is $510,401 up to $765,600, or even jumbo, anything above that, you're getting a wide variety of different offerings out there. So some of the big banks are, what I'm seeing them is on purchases, they're offering fairly competitive rates on jumbo loans. Nobody seems to have really great rates at the moment on high balance conforming, but I say not really great, but we're still talking about rates that can possibly be in the high threes to mid fours, which, as somebody who's been in this business 15 years, I still think all of those rates are great, but we've been spoiled by, seeing rates in the threes and knowing that conforming rates are in the low threes. So the expectation is a little bit off as to what the consumers expect and what is actually being given. And part of that also has to do with the media portrayal of rates, which is they're typically saying rates are coming down, 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 but what they're always referring to is the base conforming loan. So $510,400. What is a loan amount nationwide? They're not talking about specific to high cost areas like California, New York, or other areas where you have separate loan amounts that are still conforming, but it's high balance conforming. So
right.
Good. But they certainly are unstable. They're moving around a lot on a daily basis.
Okay. I mean, the fact that we're talking about rates means that you guys are still doing business. I mean, in real estate, things have really slowed down. Not a lot of buyers looking right now. Sellers are pulling back. They're a little uneasy, but you're still lending money, right? I mean, you're still.
Yeah, so we are still lending. I would say that the majority of the business that I'm working on these days is refinance business, not as much purchase, although I do have a handful of purchase transactions still going, and I do have a few clients out there making offers. So there's still some activity on the purchase side, but the majority of the business is refinances, and the banks are still lending. They're not, for traditional lending, they're not pulling out. So loans, it's just the rates are kind of moving up and down every day, and hard to guess where they're going to be today, later in the day even, or especially knowing where they're going to be tomorrow. But
Right.
Still opportunities right now, absolutely.
And timing wise, I mean, we're used to you working fast. We can do fast contingencies with you, remove appraisal loan really fast, close fast. How do you see that's changed over the last few weeks, or has it?
That's a good question. I believe it has. So yeah, we're used to, typically I was doing maybe 10 or less day contingencies and doing 21-day closes. I'm finding that right now, because each bank, literally, there's no correlation between rates between one bank and another. Normally, banks all are kind of in the same ballpark, but now they're completely out of one ballpark and one in the ballpark. So what I find is that my business now is mostly brokered. So I'm a direct lender and a broker. Whereas when I did these fast closes, I would do it as a direct lender because the rates were about the same as brokering. So it just made the process faster and easier. My bank is working on getting their rates back down on the conforming loans, but just like all other banks on anything greater than 510,000, it's hit or miss. And so what I find myself doing is brokering a lot more loans. And when you're brokering, you're dealing with longer timelines, but these are not tremendously long timelines. We're talking about like what's considered standard 30-day closes and maybe 15 to 17-day contingencies. We can still make that happen on a purchase transaction, but I think the shorter timelines really are out of the question at this point, just because of all the instability going on, that we just can't give those kind of assurances right now.
Right, that makes sense.
You brought up the appraisals with the stay-at-home directive. Are you having issues with appraisals or anything like that?
Great question. So the reality is most loans, if they're conforming, so again, something that's sold to Fannie Mae or Freddie Mac, which in Los Angeles County is going to be anything up to $764,600. We are getting, many of the transactions we're doing are getting appraisal waivers. So basically we run it through an automated system with Fannie Mae and Freddie Mac, and it determines whether or not, based on the sales price, if they're going to just waive the requirement for an appraisal. So a lot of them are coming back with waivers. Higher loan to values, obviously they're not going to get those. If you have good equity, you're going to get that waiver. And then there are other options that are coming up too, which is that they're giving appraisal waivers, and then they're also doing exterior only appraisals to help keep people from being in contact with each other. They have the appraiser just take pictures of the outside of the house, and that's what they're using to come up with the value. And then in some cases, there's still interior appraisals happening. And it actually recently in Long Beach, I had an appraisal come in a little bit low recently. And I think that what I'm seeing is appraisals are also being a little bit more conservative these days, just because we're walking into an unknown. And so my appraisal in Long Beach came in a little bit low, not tremendous, but a little bit. And I think, what we're seeing is just people being extra cautious about what they're doing.
It's interesting. You mentioned we have an escrow that's going right now, and they're doing no appraisal for two reasons. It falls under the price range that you were talking about. Plus, they're putting a substantial down payment down, so they're not even bothering with it. And
yeah, it's huge help in this environment with the health happening. It's the best thing we can do is keep everybody distanced.
And then my brother, he's refinancing, and they did the drive-by. And he was happy because, there's real concerns about people coming into your home, just as you mentioned. So he was able to do the drive-by, and it came in fine for him, and, they're moving forward.
That's excellent. Yeah. It's interesting. The one, and I know this is probably a topic subject later, but I'll bring it up now, is that even though appraisals have come up with a way to avoid contact, notaries have
right.
not. And I know there was a bill put Congress to pass to allow for remote notaries to be allowable in the state of California, and for recording and everything. But I really think that this is going to be something that's going to be an evolution in the future of the mortgage business, but it's not going to help us in this current time. So right now we still are having to have notaries meet with clients to sign. And most of my clients are doing refinances. It's interesting. They're all finding ways to do this in a sensible fashion. So they're setting up tables outside their houses and doing the signings outdoor and keeping themselves distanced, sitting on the opposite ends of tables. And notary part is not avoidable yet. I know it's, but I have a feeling that by the time it's implemented and everything happens, it'll be, post the current health situation anyways, but it'll be good for the future of the business just to make everything easier.
Yeah, absolutely. I mean, that's interesting, and it's actually good advice. And what you just mentioned about having to deal with notaries and doing it outside, and just doing whatever you can to protect yourself with minimal, doing social distancing, especially while signing your documents.
Absolutely. I think it's important. I mean, I've had one client, his wife has underlying health issues, and he was going to get a tremendous rate. It was going to save him $600 a month, but he canceled his refinance when the docs came out, just because he didn't feel the risk reward was worth it, which I can completely understand. And, that is, so it's not going to be for everybody, but I think that, most people, if we take precautions, try to cover our mouths and noses if we have masks or if we have scarves, anything we can do to protect each other. And, maybe even wear gloves when you're doing the notary signing and gloves afterwards. But we can take precautions to make it so that we can get through this and we can still make transactions happen for those that want to buy, sell, or refinance. We'll make it happen.
Yeah, no, it's all good ideas. One thing I know that has changed, and we've talked about this, actually, all of us have, just went through something like this without naming names and specific properties. Non-traditional financing seems to have gone by the wayside. And we recently had a escrow, or we're looking to cancel because of basically the buyer can't get the loan, can't get funding. Can you talk a little bit about that part of the lending side?
Yeah, so lending that people get at banks is called QM lending these days, which means a qualified mortgage. And then in the last few years, smaller lenders have come out that are backed by hedge funds that they offer what we call non-QM lending. So it's stuff that fits outside of the box of what traditional banks will lend. This can include loans where self-employed people qualify based on 12 months of bank statements, the average deposits on those bank statements. And the thought behind that is that, maybe their tax returns don't reflect their actual, their true income compared to looking at the cash flow of their business. So we look at 12 months bank statements. There's 24-month bank statement loans. There were stated income loans there. And then for investment properties, there's two particular type of loans. And one of them is the one that's affecting our situation that you're speaking about, which is a DSCR loan, which is basically a loan that's called debt service coverage ratio, meaning that as long as the income of the property covers the debt servicing, meaning the mortgage, taxes, and insurance, then the person qualifies if they're buying it as an investment property. And then no ratio is taking it a step even further, where they're just saying, hey, if you have a big enough down payment and it's an investment property, we'll give you a loan. And these were all great alternatives to hard money lending, because these could be 30-year or 40-year fixed mortgages, with very more traditional type terms. But what's happened is, you're right, is that the hedge funds that back these type of loans, just like the stock market when it went on a run, and as it continues to, people want to sell and be liquid. And the issue is that with that, the banks, the lending institutions that offer these loans lost their backing, financial backing, and literally overnight we saw these loans disappear. Now, there are a couple of lenders still out there for for bank statement qualification loans, not DSCR, not no ratio. Those are completely gone. But for somebody who's buying owner occupied, owns their own business, can't qualify using tax returns, if they can do 30% down, which a week ago it would have been 10% down, but if they can do 30% down, then and they're willing to take a rate in the 5 or 6% range, there are ways for us to still qualify them. But the majority of those type of loans have disappeared last week, and certainly 100% of the DSCR and no ratio loans for investment buyers, I'm not seeing any of those anywhere anymore. They'll come back. Yes. How long? I think it'll be a while. I think it may be asking like, when are we going to have a vaccine? That may be when I see this money come back, when we'll feel more comfortable that this is part of our past and not part of our present.
Yeah. It's all good information. You don't have a crystal ball, but you're always a wealth of knowledge, and when on this topic, do you see any more major changes coming down the road with lending?
Yeah, so what I'm seeing is a lot of banks are adding what we call overlays. So overlays means that Fannie Mae and Freddie Mac have their own set of guidelines that banks have to adhere to in order to sell their loans to Fannie or Freddie. Overlays is where banks are saying, hey, even though these are the only rules that apply for us to be able to sell the loans, we're going to add our own additional rules. So for example, one bank I work with, they're saying anybody who wants to refinance or buy a multi-unit property, I mean, this is particular to one bank, so this is not across the board. They're saying they won't use any rental income from any of the other units because they're not convinced that there's any rent coming in or that the rents are going to be paid. So they want the client to be able to qualify without any of the rental income at all. That's one bank. That's not what I'm seeing across the board. Other banks have set up rules where they're verifying employment up until 1 day before closing instead of what used to be usually 10 days before closing. They're checking it right up to the last minute because they want to make sure that the borrowers are still employed, that they're not laid off. I expect that we're going to see more and more of these overlays, just ways for the banks to protect themselves. You know, so I've seen others that say, hey, on government loans that normally qualify with a 640 or better credit score, now they're saying they want 660 or better. They're just everybody's getting more conservative. They're just wanting to protect the money that they lend out, make sure that they're good loans, and you know, they're lowering their risk factors. So I don't think it's going to be dramatic though, because most of the rules that got put into place after the financial crisis in 2007-8, most of those rules protected the entire business already. So it doesn't require a lot of more change now with what's going on compared to what was already implemented over a decade ago.
Okay, good to know. I think that kind of sums up everything. You know, there's so much more to talk to you about on other topics, but we just kind of want to give people that are tuning in a little bit of updates on how our current environment is being dealt with by lenders. So, all right, Daniel, thanks for joining us. We wanted to give anyone that's tuning in some additional information of what's happening in the lending world during the current environment. We're going to have you back another time on other topics, but we really appreciate you being on here with us. And for anyone you looking for a loan or any lending information or advice, we're going to have Daniel's contact information below with Finance of America. Daniel, thank you again for joining us.
Thank you, Adam and David. Appreciate the opportunity to help.